Welcome to Taking Stock with Lisa Brown. Today we're going to be talking about some of the tax law changes that happened in 2020 and how that impacts individuals filing their 2020 tax returns, which we'll all be doing over the coming weeks and months here. And we're also going to share what moves that you can still make to lower your personal taxes for last year. I'd like to welcome my guest today, Doug Neal, tax principal at CPA firm Windham Brannon. Doug's got over 15 years of experience in tax compliance and planning for high net worth individuals. Windham Brannon clients are Atlanta-based middle market companies as well as nonprofit institutions, including high net worth individuals, C-suite executives of companies. Welcome, Doug.
Thanks for having me.
So the first question, Doug, I'd like you to share a little bit with our audience about is the tax law changes that happened last year in 2020 that impacted individual clients. What was new?
Yeah, so there were several changes in 2020, and I can touch upon a few that really impacted individuals. First and foremost was the suspension of the required minimum distributions from IRAs. Many people actually took this as an opportunity to convert some of their IRA or what would have been their required minimum distribution to a Roth. But be sure to start those back up in 2021. Assuming Congress doesn't extend such a provision to suspend those RMDs, you want to make sure you do start those back for 2021. Penalties can be pretty stiff for not taking it. Of course, we don't know what's going to happen in 2021 yet. I don't expect or anticipate them suspending it for a second year, but something to keep an eye out. And a lot of clients have already started asking me the question of when they have to take their RMD, and the IRS really doesn't care what part of the year that you take them. You can actually wait until December 31st if you wanted to, as long as you take that required minimum amount. Another item that was unique to 2020, as well as 2021, is a $300 above-the-line deduction for charitable contributions. You know, with the recent tax law changes in 2017, upwards of 85% of people now take the standard deduction versus itemizing their deductions, which means if you're giving some money to charity on an annual basis, you're really not getting any sort of a tax benefit from that. For 2020, for every return, if you do charitable giving and take the standard deduction, you can actually still get the standard deduction plus up to $300 additional deduction for charitable contributions. For 2021, they actually changed that to $600 if you're married filing jointly, $300 for a single individual. Another big one that doesn't apply to a lot of people, but applies to some, is the 60% limit removed from charitable contributions. Traditionally, the way the rules are written, if you make $100,000 and you were to donate $70,000 to charity, which isn't that many people, but some, then you can only deduct the first $60,000 or 60% of your gross income. The other $10,000 gets carried forward to the next year. What the IRS and Congress did, because charities were struggling with COVID, and to incentivize some of those higher net worth individuals to donate more, if you're making cash donations to charities, not to a donor advised fund and not to a foundation, not appreciated stock, they actually removed that cap. So if you made $100,000 and wanted to donate $100,000 in 2020 in cash, you could actually essentially wipe out all of your income and not be limited to that 60%. So for those that are really strongly inclined to donate, this really was a big benefit and something that allowed them to really maximize and supercharge those donations.
Yeah, it's a win-win for the individual and the charity, isn't it?
It really is. The last one, and I won't touch on it much, but it is the one that we've received the most questions on, and that's the Paycheck Protection Program. Congress did recently pass a second round of funding. I heard from a client today that they received their funds, which those funds can be used for businesses to pay payroll costs. One thing I want to point out that I think has been overlooked by a lot of people is that individuals who have sole proprietorships or independent contractors with no employees or just a few employees also actually qualify, and they can consider their own profits on their Schedule C as wages for purposes of that loan. So, if you happen to be in that situation, you may actually qualify even though you don't have any employees to speak of.
So for somebody in that situation, Doug, an individual contractor, should they be looking to their tax advisor to help them figure out if they do qualify, or should they talk with their local bank? What's usually the best course of action for them to take to determine if they qualify?
Well, I think both of those are good options. The banks are really up to speed on those rules, but I recommend reaching out to your CPA and double checking, make sure that that's something that may be an option for you with regards to the rule. And then, of course, you'd need to go to the bank to go ahead and do the application process and everything else. Both should be qualified to at least set you on the right path and answer the question to see if it's a viable option for you.
So it sounds like some of the new changes in 2020 are rolling into 2021 as well. So it's we'll probably have a similar conversation this time next year. I believe so. Given these changes, Doug, people are right now, they're starting to look for their 1099s and their W-2s and pull all their tax forms together. But what additional information do people need to be thinking about gathering together now and being prepared to send their tax preparer this season that maybe they haven't had to think about before?
Sure. Well, I think in any year, a big key is identifying year-over-year changes to your CPA. This might not mean you have all the answers as to how it impacts you, but it allows the CPA to ask the follow-up questions. And that could be any number of things. We touched upon the 2020 suspension of RMD, so that might be a year-over-year change that they may be looking for your RMD, but you didn't have one. Or if you donated a portion of your RMD directly to charity, those would be an important thing to bring up. If you made a large one-time cash gift or a gift to a donor-advised fund. With 2020, there were a lot of changes with regards to portfolio allocations and rebalancing. If you did do significant changes to your portfolio, you might want to bring that up or point that out, because that could mean there's some significant gains or losses that would not have been there in previous years. If you were let go or retired, you might have a severance package or a change in income from that perspective. So you might want to revisit whether estimated payments are important. If you move states or started a new business on the side, that'd be important. Or if you just moved to a different place in the state and purchased or sold a home. If you did an IRA rollover or a Roth contribution, or maybe you started Social Security, really any of those one-time items that weren't there before. CPAs tend to use the prior year return to look for what missing information is there. So if it didn't happen in the prior year, we don't necessarily know to ask it. One thing that Windham Brannon does is we actually provide a 6-page questionnaire to all of our clients. Really is meant as kind of a roadmap to alert us to any one-time changes or unique items. Again, we're not expecting you to have the tax answers. What we just need to know is the event took place. And that way we might be able to see an opportunity of, okay, well, if this happened, then you might qualify for that. Specifically for 2020, an important item to identify is the amount of the economic income payment or the stimulus received, if any. Many of our clients didn't get a payment given their income levels, but there is still the possibility of receiving a stimulus payment through your 2020 income tax return. The stimulus payment was really meant as a payment to cover 2020 income level drops, but obviously the IRS didn't have that information as of yet. When the first stimulus payments went out back in March, April, May of 2020, most people hadn't even filed their 2019 return yet. So the IRS looked at 18 as their most recently filed return to determine qualification and how much of a stimulus payment you might get. For a single individual, that was $1,200, or a married couple, up to $2,400. We have a second stimulus payment that has already hit many accounts in January for another $600, and they were talking about another $1,400. All of those calculations were really meant to be a 2020 number. So if you qualified for a stimulus and your income went up in 2020, you don't have to repay it back, unlike some of the previous things that have been done by Congress. But if you didn't qualify, or you only received a portion of your stimulus payment based on your prior year income, and then in 2020 your income actually went down, you can actually get that difference, whatever additional stimulus you should have received based on your 2020 income levels. The example that I think we're going to see a lot with our clients is a retired couple making maybe $100,000 of investment income and Social Security income and $125,000 of IRA distributions. They would not have received a stimulus payment because their income was too high. But if in 2020 they didn't take their RMD and had that same $100,000 of investment and Social Security income, well, now they would actually qualify for the full stimulus payment. For a married couple, just on the first payment, that could have been $2,400. And that actually shows up essentially as a payment on their 2020 return. So if they owe money, it would decrease by that amount. If they're getting a refund, it would increase their refund by that amount. So we're asking all of our clients to know how much economic income payments they received so we can calculate what they're supposed to receive under 2020. And if that amount is more, they'll get that additional credit.
Yeah, that's really helpful to know. And I think another reason to make a plug of all years, 2020 is a good year to make sure you've got a good tax professional on your team because, this is something that, an opportunity people probably aren't aware of that you want to make sure you don't miss, if you do qualify for, let's say, a makeup payment on the stimulus. So that's really, really good advice. And, one that I hadn't heard many people talk about, but it could be a nice surprise for people when they file the return in a couple months.
Yeah.
So speaking of which, Doug, we only have a couple months left before we've got to file our tax returns. Is it too late to do anything now to still try to lower my taxes for last year? Or are there some moves I can take advantage of in the next couple months?
Not necessarily. There are still kind of a couple things that you can do, and three items really kind of particularly come to mind. The first two are more Georgia tax benefits. So if you live in Georgia or have Georgia tax liabilities, you may want to consider these. The Georgia 529 plan for qualified education expenses set up for children, grandchildren, whatnot, you still actually have until April 15th of 2021 to make a 2020 contribution to those 529 plans and count it towards 2020. Aside from the benefits of a 529 plan of growing tax-free, and if you use them for qualified expenses, all the growth is also tax-free, another added benefit in the state of Georgia is you can get up to a $4,000 deduction per beneficiary per year per donor. That means a married couple could contribute $8,000 to a Georgia 529 plan per child or grandchild. So if you're a married couple with two children, you could make up to a $16,000 contribution and get a $16,000 deduction on your 2020 Georgia income tax, even if you don't make it until now. Yeah, it comes out to about a $920 tax savings off your Georgia tax bill. And that's something that if you're inclined and want to continue making those contributions, really could be an annual benefit of $900. We see a lot of our clients doing this. I will caveat that in order to get the deduction, it does have to be the Georgia 529 plan. There are 529 plans in every state, and you are certainly willing and able to contribute to any one of those if you like those investment options and still be used for any expenses, but you do have to make it to the Georgia plan, and it cannot be a rollover from another state plan.
Right.
A second big one is the Georgia film credits. The Georgia film credits are a great option for higher income earners. The Georgia production industry has thrived thanks to this incentive. I won't bore you with the details other than to say that companies are provided significant state credits to spend money in Georgia for movies, TV shows, commercials, etc. Most companies cannot use all the credits that they earn to offset their Georgia tax liability, so they have the option to sell those credits to third parties. How our clients benefit from this is from purchasing credits from those companies like Disney, AMC, Warner Brothers, and others, and utilizing those credits to offset their Georgia tax liability. The current market is 88 to 90 cents on the dollar, so if you happen to have a $25,000 Georgia tax liability, you can satisfy that with maybe $22,000 of cash outlay, purchasing $25,000 of the credits and satisfying that obligation. And again, it does not have to be done by December 31st. You could still purchase film credits today. There are also beneficial in the sense that they don't involve getting into any sort of a partnership or complicated structures. It's a one-time contract and transfer of those credits to you. Additionally, because of the popularity of it, because of the desire for individuals to be protected, really all the credits that we deal with, the companies themselves offer an indemnification clause. So if for some reason or any reason those credits are disallowed, the company will make the purchaser, the individual, made whole by covering the tax bill, interest penalties, or other administrative costs. I will point out for 2020, we don't exactly know what the inventory is going to look like because production did stop for a period of time. But as of now, we haven't seen any issues with regards to getting film credits for our clients.
Good.
The last one, and I'll just briefly touch on this, is qualified sick leave credit for self-employed individuals and independent contractors impacted by COVID and unable to work. Again, I know it's kind of a maybe not the target audience, but Congress in the CARES Act did put in a provision for individuals who have their own business, who aren't covered by an employee sick leave act or program, that if they were impacted, if they weren't able to work during 2020, they could actually get up to a $5,110 credit on their individual tax return to make them whole for periods of time they couldn't work due to quarantining, having COVID, government restrictions, or other type things. So if that specific circumstance applies to you, I'd recommend asking those additional questions to your CPA.
That's a great point. It's just another one of those nuances for 2020, but could provide some good tax opportunities for our audience who are self-employed. And, this time of year, Doug, especially, I tend to have this concern about, did clients prepare and set aside enough cash to pay their tax bill that's due in a couple months? And for those clients that are still working in corporate America or running businesses, they may have been planning on, year-end bonuses or year-end profit distributions to come their way and use that cash to pay any tax liability that they didn't pay during the year, and they're going to owe, when they file the return by April 15th. But, with the pandemic last year, we did see a lot of companies cut bonuses or just eliminate them altogether. And so the cash outlays that, people were planning on coming around this time of year, may not be there. So what else can people do to make sure that they've planned really well for any upcoming tax bill that they're going to owe?
Yeah, no, I think it's a great question and an important one. For one, I think, and this may be a little bit self-serving, is to get with your CPA early. If there were unique things going on in 2020, like you mentioned with the cut in bonus or not being able to get that withholding payment through bonus, the earlier we can get kind of the majority of the information in, especially with a large W-2, the sooner we can start preparing you for what that cash outlay might look like. Again, it's particularly important if you have some sort of a one-time event, again, like the bonus being cut. If there was a company sale, or if you triggered large gains in your portfolio that maybe you haven't traditionally done, those are all things that could generate some sizable tax or alert you to some sizable tax due. And the sooner you can get that information and the numbers available, the better. We also try and be very proactive with our clients, projecting income in December and January. I know I had a few clients who had a very successful 2020, and we made sure to project their tax bill and cash flow needs already at a high level using some projection software. That way they're prepared to write that check come April. We never want to be delivering that news on April 14th that you need to write a check for $40,000 or $50,000. We can get the information in early, know about those one-time events, then we can better plan for it. Talking about portfolios and Brightworth, be mindful of your realized and unrealized gains. Individuals pay tax on the cumulative gains and losses when securities are sold. So check in with your advisor and see if you have significant gains in 2020. With 2020, the markets were very, very volatile, and different people took different strategies with regards to, rebalancing, changing up their portfolio and whatnot. So unlike many years, there may be bigger ebbs and flows with regards to your capital gains or capital losses in 2020 that could significantly impact you. You know, a lot of times you could take a portfolio or an investment that went down 10%, the first part of 2020 before being sold, but it increased 50% in value over the last several years. So you actually have a 40% gain on that sale, even though you might feel like there was that 10% economic loss because the other 50% prior gain you hadn't paid taxes on. So recall the S&P 5 years ago was at 1900, and I looked this morning, it's now at 3850. So essentially the S&P has doubled over the last 5 years. So you're more of a long position individual and holding these stocks for years. Even if you sold when the market dipped, you're probably going to have some sizable capital gains. And just to prepare you for that note, the long-term capital gain rate for federal is 20%. You may also be subject to the 3.8% Obamacare tax if income's over $200,000 for an individual, $250 married filing jointly, and then 5.75% to Georgia. So it's roughly 30%. So if you're looking at your portfolios and your 1099s and see that you had $100,000 of capital gains, it stands reason to say that might generate $30,000 of tax liability that you might want to be preparing for.
Right. Those are great planning points. And, thinking about the changes in 2020 and what people can do now to be proactive with whether they are going to have a tax bill or not in the next couple of months, and all really good tips. And certainly would be remiss if we didn't talk about, okay, Doug, what can we all be doing for 2021? It's never too early to prepare for taxes or your financial plan in general for the coming years. So looking forward to this year, based on what we know now with current tax law, what are the top couple of moves that people can make to lower their personal taxes for this year?
Sure. Well, I think, kind of one of the tried and true methods, and one of the ones that's best from a societal perspective is the charitable giving. That's still one of the biggest and best itemized deductions out there. Those inclined can consider, kind of pre-funding or doing some sort of a donor advised fund, setting some money aside for the next several years worth of charitable giving to accelerate that charitable deduction into 2021. If you're not familiar with the donor advised fund, they're kind of like a mini foundation without all the administrative hassles, where you can make that one-time gift, set that money aside to charity, but not actually make the contributions to charity. That money is sitting in a pot, whether with a Fidelity or Schwab donor advised fund. And then as you plan on making those charitable gifts to whatever charitable cause you have, whether it's your university or United Way or Salvation Army, you can go ahead and move those funds from the donor advised fund. One reason this is a really good idea, aside from the uncertainty of future tax law, is, as I pointed out before, 85% of people now take the standard deduction. So really, you're taking the standard deduction, aside from that $300 benefit, you're really not getting any sort of a tax benefit from making your charitable contributions if they're $5,000, $6,000, $7,000 a year. So what we've talked to our clients about doing is kind of pooling those. Again, the standard deduction for a married couple is $24,000 and change. So if you have $10,000 of property taxes, no mortgage, and you're making $10,000 of charitable gifts a year, you can actually take the standard deduction and get $24,000, which is more than 20, and really not get any benefit from that $10,000 charitable deduction. Alternatively, if you're inclined and you have the cash flow and know you want to set aside funds, you could pre-fund 5 years worth. Make the current year cash distributions from your regular checking account, but maybe put $40,000 into a donor advised fund to make those contributions in year 2 through 5. The reason for doing this, and in 2021, you actually get that $50,000 charitable deduction today, plus your $10,000 state income taxes. So actually $60,000 worth of deductions today. And then in years 2 through 5, you still get the free standard deduction. All in that example, you get an additional $36,000 of deductions when you still made the total same charitable contribution, and the charities are still getting the same money, but you're getting a nice bigger tax deduction for it. Another important thing to consider is utilizing all your payroll benefits. Health savings account, flexible spending account, dependent care exclusion, 401k, both the regular or Roth. These are all things that can add up and save maybe 30 to 40 cents on the dollar in tax-free benefits. So even a $2,000 FSA contribution to use for medical expenses, could save you $800. Last, I'd say consider if making a deductible or non-deductible IRA contribution makes sense for you in addition to your 401k. If you don't already have an existing IRA and your income levels are too high, you can still do what's called a backdoor Roth IRA by contributing to a traditional IRA and then rolling it over to a Roth a few days later. This little loophole can set aside $6,000 a year, $12,000 for a couple, or for over the age of 50, you could actually do another $2,000 to get up to $14,000 into an account that grows tax-free. And because it's a Roth IRA, there's no tax impact when you actually withdraw the funds. So if you're a younger individual and you're doing $12,000 a year, and you could do that for 25 years, well, that's $300,000 of contributions plus appreciation, which over 25 years can be significant, that have no tax impact when you withdraw it. I myself do this and have been doing it for a number of years, essentially taking $12,000 from myself and my wife's taxable accounts and put it into a Roth IRA. The money is still invested the same way, but it turns it from a taxable account to a tax-free account. And I'm sure Lisa at Brightworth can, talk you through the logistics of that and set you up and get kind of on a recurring pattern to get more money set aside in a Roth and really no tax cost.
Yeah, I think that's one of the common misconceptions I've heard over the years is people don't realize that they can put money into a 401k and an IRA or Roth IRA, depending on their situation, in the same year. So you can do both, as long as you have enough income. So those are really, really good tax tips, Doug, as we look forward to 2021. And I'd like to thank you again, Doug, for joining me today and sharing all of the 2020 and 2021 tax tips with us. And for our audience, if you would like some more information or to get some expert tax advice, you can connect with Doug at you can connect with Doug Neal at dneal, Neal, at windhambrannon.com or by phone at 678-510-2753. Thanks so much for joining us on Taking Stock with Lisa Brown, and have a great day.
Thank you, Lisa.